Well, good afternoon. Happy Friday, November 1st. Mark Milam here, your mortgage professional. Let's get right to the week. Ugh, still not a great week for mortgage interest rates. We're seeing rates on average ticking up about an eighth of a point higher as we close out this week as compared to how we started the week. Slew of economic data this week, everything from inflation to labor, jobs report, unemployment, all of that coming out this week. And really, inflation, probably the least impactful of all of these. The Fed's favorite measure of inflation, personal consumption expenditures, really ticking down another notch. We are ever so close to that 2% target for inflation. Inflation is really not the name of the game anymore right now as it pertains to what's happening with all of this economic data, yet we continue to see bonds suffer. We continue to see mortgage rates tick up after the jumbo-sized Fed rate cut. And this is really centered around three potential reasons. Listen, when you're analyzing what happens with a market-driven rate, which is a mortgage rate or the 10-year Treasury, we're essentially taking our best guess based upon data. Because this isn't a rate that is arbitrarily set by our Federal Reserve, we're all taking a look at what the 10-year is doing, what mortgage rates are doing, and we're sort of inferring what's happening or trying to figure out what's happening based upon the data that's come out. So there's three fundamental reasons why this could be happening. I'm going to go through those, but let me first show you exactly what's been happening with the 10-year Treasury. So this is the 10-year, sort of a chart of the 10-year note yield change after the first Fed rate cut of the past, maybe 30 years worth of cycles of Fed rate cuts. And that black line is us. That's how much the 10-year Treasury has risen since the Fed cut the Fed funds rate on September the 18th. And when you compare that to other years dating back to 1998, 1995, 2001, 1989, you can see we are in uncharted waters. We have never seen a spike like this in the 10-year note yield since, going all the way back into the early 80s. So what does that mean? Why is that happening? Well, there's three fundamental reasons why this could be happening. And we're going to start to figure out which one of them or which combination of them are the culprit by process of elimination here over the next couple of days. The first reason is the market is concerned that the Fed is cutting the Fed funds rate too quickly, and they're going to reignite inflation because they're going to stimulate the economy, and off we go with inflation. Inflation is bad for bonds. It erodes their value over time. So that's potentially the fundamental reason why folks think that that's going to happen. Let's take a quick look at some economic data to see if that is really holding true. So here's mortgage-backed securities. You continue to sell off. Rates continue to worsen. Let's take a look at some of this economic data and try to determine if we see some fear that inflation is going to reignite. Here's non-farm payrolls. We added 12,000 jobs in the past 30 days against an estimate of 113,000 folks. That is an incredibly weak number. 12,000 jobs created, and of that 12,000 jobs, that net job creation, 40,000 jobs were created by the federal government, meaning if you strip out the government jobs, we actually contracted. We lost about 28,000 jobs over the past 30 days. Not a strong sign of labor here. It's not like we're seeing something really robust or dynamic like we saw 30, 60 days ago. Also, we have to take into account that we did have some pretty unique events over the past 30 days. We had 2 hurricanes and a strike. So how is that number, how does that play into these numbers? That'll remain to be seen as we parse through a couple of revisions as we move into subsequent months. For today, a very, very weak number for the non-farm payrolls. Let's go back and take a look at personal consumption expenditures. Right in line with expectations, no surprises there. Not exactly a super robust economy. Job openings down to 7.4 million. That's getting really close to pre-pandemic levels. Home prices continue to go up. There's just not a lot in there that says the Fed's about to reignite inflation. In fact, if you look at futures traders, they're going to tell you there's a 98% chance that the Fed is going to cut the Fed funds rate again on November 7th, just 2 days after the presidential election. So reason number one, hey, we're concerned the Fed is cutting too much and it's going to reignite inflation. I don't know, man. Jury's not 100% back in, but I tend to discount that one a little bit. Let's look at another reason. There is two other potential reasons why this could be happening. And I'm going to flip back to my screen here and scroll down and show you what's called the Trump trade. So this is the betting market. You can actually bet on whether you think Trump is going to win the election or Trump is not going to win the election. And as it turns out, the markets and traders believe that Trump is in the driver's seat to win the election. And you can see that as goes that yellow line with an increasing probability that Trump would win the election, so goes the 10-year Treasury, meaning interest rates are worsening as the odds of a Trump victory are going up. Why would that be the case? Why would traders be trading up in the 10-year Treasury when we think that probability of a Trump victory is there? Well, a lot of Trump's policies are viewed as inflationary. Listen, this is not a political video. I'm not about to come out one side or the other and say this is 100% true, but the perception is that Trump's policies are inflationary. Tariffs are inflationary. Trump obviously wants to cut taxes or keep the tax cuts that he put into place the first time. He wants to keep them in place. These things are inflationary. They tend to spur economic growth, and if that happens and the economy takes back off again, well, that's not good news for bonds. So the second reason that we might see some degradation in mortgage rates is because of the Trump trade, and we see a higher probability that the markets believe that Trump is in the driver's seat to win the election come next Tuesday. That's reason number two. Maybe, maybe not. I tend to gravitate towards reason number three. And reason number three is a much more difficult problem to solve, and it centers around our federal deficit. It's something I talked about a week ago on this very same channel. Let me flip my screen back around, and I'm going to scroll down to a chart that I went over last week. This is a chart of federal spending as a percentage of GDP. Let me get back to it. Federal spending as a percentage of GDP, and it's the entire history of the United States. And only 4 times in the history of the United States have we been spending money like we are spending now. Listen, we are a Keynesian economy here in the United States. And what that means is when the economy slows down, when it enters recession, when we're contracting, the federal government spends to spur economic growth to bring us out of it, right? Think the pandemic. Think the Great Recession back in 2008, 2009, 2010. Think about those time periods. The government is spending money to spur the economy to resuscitate us out of recession. At the same time, it's anticipated that when the economy is doing well, when the economy is performing, that the government would rein in their spending, right? No need to continue to stimulate the economy. You could risk overheating it, but that's not what we've been doing. We've been stimulating even though the economy has recovered. And we're spending money as a percentage of GDP on par with World War I, World War II, the Great Recession, and the pandemic. 4 times in the history of the country that we've ever done this. And my assertion is when you see this weak economic data come out today, 12,000 jobs created in the past 30 days. And if you strip out the government jobs, we actually subtracted 28,000 jobs. Yet the bond market continues to worsen. That tells me this is not about economic data anymore. This is not about who wins the election. This is not about whether the Fed's going to cut or not going to cut come November the 7th. This is about our federal deficit and our government spending. And until we get that in line, the bond market is going to continue to not trust anything else. And I think we're going to continue to see upward pressure on interest rates. Uber important that our leaders in our federal government get their economic policy in order, get their financial house in order, not only for future generations, but also for interest rates and the affordability of everything that comes with borrowing money. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.